So, bro, what's up?
Well, Alison, a giant in the financial advisory business is retiring. Chances are most investors don't know the name of Harold Evensky, but he's a pioneer in the world of sort of research-based financial planning. It's pretty safe to say that there's no advisor who's won more awards or accolades than Harold Evensky. He's so respected that one of his clients is psychologist Daniel Kahneman, who won the Nobel Prize in economics and is considered one of the fathers of behavioral finance. So if a guy that smart is going to Harold Evensky, you must think he must know what he's doing. So Harold just turned 76, and he gave his final speech last month at a conference in San Diego. And the speech was summarized by Robert Hoopsher for advisorperspectives.com. There's a lot of good stuff in there, but I'm just going to highlight 4 key takeaways. So number 1, expect lower future returns. So Evensky recommends that after fees, taxes, and inflation, investors should expect to earn just 2% a year on average over the next decade. So not over the next year or 2 or 3 years, we don't know, but over the next decade, we should expect pretty low returns. Now, he's not the only person to predict that the markets will provide below average returns, but it's particularly notable coming from him because for a very long time, some of the financial planning software that is most commonly used by financial advisors relied on Harold Evensky's predictions for their return assumptions. So his predictions are fairly well respected. In a speech, he emphasized that in a low-return world, managing fees and taxes is even more important than ever, which brings us to number 2, and that is be both active and passive. So the debate of whether investors should try to beat the market or whether they should just stick with index funds, that rages within the financial advice business as well as without. What does Evensky recommend? He says you should do both. He was actually one of the early pioneers of what became known as the core and satellite approach to investing. Core of your portfolio should be index funds. It's clear that they outperform most active strategies, but more importantly, very low cost and very tax efficient. Then once you have your core in index funds, you can do what he called satellites in your portfolio. Try for more aggressive strategies, try for a little more active management, see if it works out. Could work out, but not everything's riding on those. And make sure you do it in your IRAs because generally active strategies are more tax inefficient. Number 3, don't invest money you need in the next 5 years. So that may not sound particularly insightful. Everyone knows to keep short-term money out of stocks, but the actual size of that cash cushion differs by whom you ask. Even I'm a little squishy about it. I tend to say, like, if you don't need it in the next 3 to 5 years. Some people will just say in the next 1 to 2 years. So I think it's significant that someone like Harold Evensky is saying, no, 5 years is really what you should be targeting. If you need that money in the next 5 years, it should not be in the stock market, especially if you're retired, because that's generally the length of an economic cycle. And number 4, the last one, give annuities a fresh look. So like many experts, Evensky derided annuities for years, and I did this as well. But that's changing a bit, mostly because the cost of annuities has come down so much. And by annuities, he's generally talking what are known as single premium income annuities. You hand over a large lump sum to an insurance company, and they pay you a check for the rest of your life. Regardless of what's going on in the stock market, with interest rates, the economy, how long you live, you know you're going to get that check in the mail each and every month. He thinks that actually, generally speaking, the research is that you should wait until you're age 70 to do it, because the longer you wait, the higher your payout, because it's based on life expectancy. But 20% or more of a retiree's portfolio could be in annuities, and that would generally replace what you would otherwise invest in cash and bonds. So those are just 4 takeaways from Evensky's final speech. There's plenty more from that presentation, from the many speeches he's given over the years, as well as the many academic papers, articles, and books he's written. So if you're looking for some good, like evidence-based financial planning, just Google his name and you'll come up with some pretty solid stuff. And finally, I'd like to say that after spending decades of helping other people retire, I wish Harold Evensky the best now that he finally gets to retire all on his own.